So the next question comes from one of the live attendees, and they asked, with all of the rapidly rising real estate prices, what do you think about investing in REITs?
I'm going to start, but again, Larry's an expert in all this. I just want to stress that we don't try to time the markets. And I know there are a lot of questions in the chat that says we answer these the same way. It's because we answer them the same way. It's what we believe. And if it doesn't work for you, that's okay. Go find someone who you think can time the market. So we are going to—
Oh, Adam, and let me know when you find that person.
Right. So what we're going to— it's boring. It is not sexy, but all the Nobel Prize winning evidence says that it works. So we are going to apply, again, that evidence and say, you're going to have a diversified portfolio, because we're the first to admit we have no idea what tomorrow brings. So real estate absolutely went through the roof last year, and we pared it back based on the rebalancing we talked about. Guess what? It's not doing so well this year. When it's not doing well, that tells you you have a higher expected return, but we're not making any bets. We're sticking to the plan, as boring as it sounds. Last but not least, and this goes back to what Jim said, if you have 3% of your portfolio in real estate, that's a fraction. If it outperforms the market, whatever that means, that's also a fraction. It's right of the decimal point. We really think the value add is keeping the money away from the tax man. It's loss harvesting, it's moving money out of your taxable estate, it's gifting, it's all of those things. I am the first to tell you that the portfolio management, the allocation, whether it's to an alt or large cap or small cap, will not make a difference in your lives at that individual asset allocation level within the asset class.
That said, Adam, is there any difference in your allocation or in your answer if somebody has a substantial ownership in an expensive home, or maybe even two homes? So let's say that one of your investors is a snowbird, and maybe they have $1 million house in the north and $1 million house in the south. Would you treat that differently than somebody who is, say, renting or has a more modest house and doesn't have a lot of money in real estate?
We don't— what I would say, Jim, is we'll look at it in terms of your goal, in terms of what you want to pass to children, unless you plan on selling that home to fund lifestyle. And then we'll look at the probability of being able to get what you want. Certainly, we all think you should be able to sell the home for what it's worth, but we know that home prices cycle nonetheless. So we generally focus on liquid assets when we build these portfolios, recognizing someone who might have a pension might be treated differently, or somebody who has a home that they might sell. We prefer not to try to time the market based on the sale of a home, though.
All right, well, that brings up another question. Sorry about that. I should let more people get in, but I'll just do this quickly. Two people have the identical amount of money. Client A worked for a railroad or worked for some kind of organization that doesn't pay them Social Security. Client B has both a pension, and he and his wife both are getting Social Security. So you have a pension and Social Security, let's call it, and let's call it significant type of income, but the portfolios coming into you are identical. Are you going to shift your asset allocation based on the fact that one has a guaranteed income? Let's forget about the safety of the pension, but one has a guaranteed income and one doesn't. And I might ask Larry the same question, because he might have a different answer.
Since I did a lot of the talking in the last 5 minutes, I'll let Larry start.
No, go right ahead, Adam.
I would say, if you use the caveat, don't consider the safety of the pension, certainly we would probably change that. But we've seen pensions cut in half by the government or company or whomever. So I would say that certainly bakes into our analysis. But if there is a steady stream of income, maybe from an existing trust or some other source, absolutely we consider that into our analysis.
Yeah,
Go ahead, Larry.
The way I think about these things is, where a pension should be thought of in exactly the same way Social Security should be treated. And there are people who try to make this complex. So they'll turn Social Security and say it's a bond. And then you've got to figure out what that cash flow is worth. Say it's $20,000 a year. How much is that equivalent in a bond? And you're going to change that every year depending upon where the interest rates are. I think that's way too complex, unnecessary. The way to address it is pretty simple. Is let's say a client comes in and meets with Adam and says, my goal is to generate $80,000 a year of spending power. And so what Adam does is says, all right, how much Social Security are you getting? And by the way, that's in an inflation adjusted term, so it should go up in the future, which Social Security does. So if you're getting 40,000 in Social Security, now my need to take risk is lower. It's not 80,000 a year. I only need 40. Now, if I had an outside pension that was considered safe, and that was giving me another 20,000 a year, now I only need to generate 20,000 a year. And a good rule of thumb used to be that you needed about 25 times your need for cash flow. So a 4% safe harbor rule. 4% is 1/25, so that's how you get the 25 times. So if you had 80,000 in need times 25, you need $2 million, right? And that portfolio. So that's our goal, is to get you to a $2 million portfolio. If on the other hand, you only need 20,000 because of Social Security and your pension, now you only need a $500,000 portfolio. So Adam can say, hey, you're already there. We've got $500,000. We could get by with a very safe portfolio. Maybe it should be at least 20% equities, because some periods stocks do better than bonds. So you don't want to generally own less than 20%. We could go 20, 30, maybe 40 at the most, depending upon your other objectives, but you don't have need to take more risk. And it's that pension that allowed me to lower that equity allocation. Maybe if I need 2 million, I might have to be 60 or 70% or 80% equities to get that goal with a high likelihood of achieving it. So the simple answer is pensions in whatever form, or cash flow in whatever form that you're getting, if they're known, reduce your need to take risk, which means you can get by with a lower equity allocation and can hold safer, more safe bonds.
Thank you.